Have you ever looked past the big headlines about, say, Google, and really wondered, is this company genuinely shifting to be AI first? Or is it more talk than action? Today we're doing a deep dive into Alphabet's Q2 2025 financials. Alphabet, of course, being Google's parent company. And our goal here isn't just, reading out numbers. It's about getting behind those figures, understanding the why of their big strategic plays, and what it signals for their future. We're drawing straight from their official results report.
Exactly. These quarterly reports, they're not just spreadsheets. They're like a window into a company's thinking. You get a real sense of their priorities, their health, and, well, where they're headed. It's like their strategic blueprint laid bare.
Okay, so let's dig into it, keeping that core question in mind, the AI transformation. Alphabet had a really strong Q2 2025, financially speaking. Beat expectations. But for a company this massive, what does a quarter like this really mean? Beyond just, good numbers, what were the main things pushing those results up?
Well, if you look at their summary, the consolidated revenues hit $96.4 billion. That's up 14% year over year. Now, for a company pushing towards a $1 trillion valuation, keeping up double-digit growth like 14% is quite something. It says a lot about demand, sure, but also their ability to scale efficiently. Net profit came in at $28.2 billion, up 19%, which is impressive. And diluted EPS, earnings per share, was $2.31, up 22%. The main drivers, no question, Google Services and Google Cloud, they were the powerhouses this quarter.
Okay, and here's something that really caught my eye in the report. Their strategic investments, specifically capital expenditures, CapEx, it surged like 70% this quarter alone, $22.4 billion. That sounds like a massive amount of cash going out the door. How did that spending affect their free cash flow for the quarter? Because a 61% drop in free cash flow looks pretty stark on paper.
It does look stark, you're right. And it did directly lead to that 61% drop in quarterly free cash flow. But, and this is crucial, it's not a sign they're struggling. This money is very intentionally going into things like advanced AI chips, new data centers, beefing up their cloud infrastructure. It's a very deliberate trade-off. They're building a much faster engine for the future, even if it means less fuel in the tank right now. It's definitely a long-term play, sacrificing that immediate cash for what they hope is dominance in AI and cloud down the road.
Right. And Sundar Pichai, Alphabet's CEO, he called the quarter outstanding. He really emphasized AI's impact everywhere. What did his comments tell us about their strategy? Does it line up with where they're putting all that money?
Absolutely. Pichai said, and I'm quoting here, AI is positively impacting every part of the business, driving strong momentum. He specifically mentioned new things in search, like AI overviews, those AI summaries you see at the top now, and AI mode for deeper dives. He also really highlighted Google Cloud. Strong growth in revenue, yes, but also in backlog and profitability. Said its annual revenue run rate is now over $50 billion, so it connects directly back to that huge CapEx figure. They're pouring resources into the areas where they see massive growth and future returns, betting big on AI being central to that.
Okay, so we've seen the big picture, the strategy. Let's zoom back in on those consolidated numbers. Beyond just revenue, what can we learn about their overall financial health? Thinking about operating income, operating margin.
Sure. So consolidated revenues, $96.4 billion, that 14% increase. Net profit, $28.2 billion, up 19%. Diluted EPS, $2.31, up 22%. All strong. But what's really interesting is the consolidated operating margin. It held steady at 32.4%. And that's despite those huge investments we talked about. And even absorbing a legal charge in the quarter, it suggests either they've got good underlying cost control or simply that the revenue growth was strong enough to cover those increased costs. Probably a bit of both.
All right, let's break it down segment by segment. Google Services is still the behemoth, right? Driving most of the revenue. But within that, were there any standout areas? Are they making real progress diversifying away from just traditional search ads?
Oh, yeah. Google Services revenue was $82.5 billion, up 12%. Operating income also up 12% to $33.1 billion. That's a very healthy 40.1% operating margin. But inside that, YouTube ads were particularly strong, up 20% to $11.2 billion. And the subscriptions, platforms, and devices category, that grew 13% to almost $9.8 billion. So yes, that strength in YouTube and subscriptions is really important for them. It shows they are successfully diversifying, making the whole company less dependent on just search ads, more resilient.
Okay, now Google Cloud. This has been a huge focus for Alphabet, right? But what seems really different this quarter isn't just revenue growth, it's the profitability jump.
Right.
What were those numbers and why are they so significant for Alphabet's future? Especially thinking about that AI transformation question.
Right. Google Cloud revenue hit $13.6 billion, which is a very strong 32% increase. But like you said, the really transformative piece is the operating income. It surged 32% to $2.8 billion. And that pushed its operating margin up dramatically from 11.3% last year to 20.7% this quarter. Almost doubled. That leap is huge. It validates all those massive investments they've been making in cloud. It shows it's really maturing, becoming a serious profit engine, not just a growth story. And connecting to AI, better cloud margins mean more money to fund more AI development. It shows the infrastructure investment is starting to pay off directly on the bottom line.
So services and cloud are the big engines now, but Alphabet also has these other bets, the long-term moonshots. What did we see there this quarter? Any breakthroughs or still mostly investment mode?
Mostly investment mode still. Other bets revenues were $373 million, just a small increase, but the operating loss actually widened a bit to about $1.25 billion. So yeah, it just reinforces their role. These are long-term, high-risk R&D projects. Think Waymo, Verily, not expected to make money anytime soon.
Got it. Okay, moving away from the core segments for a moment. What other significant things happened in Q2 that investors might be watching, things that could affect the stock price?
Well, we have to come back to that CapEx number, that 70% jump to $22.4 billion, and they flagged a full-year plan of around $85 billion. I mean, that level of spending is just enormous, even for a tech giant. It screams confidence from management about future growth in AI and cloud, but, there's always execution risk with spending that much that fast. There was also that charge for a legal settlement. The report didn't specify which one, but Alphabet always has legal things going on, antitrust, data privacy. While it's a cost, actually settling these things can sometimes be good for the stock, removes uncertainty, takes away that overhang. And one more thing, back in May, they issued $12.5 billion in senior unsecured notes, basically borrowing money. This helps fund that CapEx without issuing more stock, which shareholders like, but it does add to their long-term debt and interest payments down the line.
Okay, so if we try and tie all this together, costs, cash flow, how does it all connect? What drove the overall cost increases, and why did free cash flow drop so much this quarter, even though cash from operations actually went up? And what about that crazy 2,000% jump in other income? That sounds wild.
Okay, let's break it down. Overall costs and expenses went up 14% to $65.1 billion. R&D spending was up 16%, growing faster than revenue. But the big jump was general and administrative costs G&A, up a whopping 65%. That G&A spike is mostly because of that legal charge we mentioned, plus some other one-off things like severance costs, maybe office space adjustments. Interestingly, sales and marketing costs actually dipped slightly. Now, cash flow. Net cash from operations was actually up 4% to $27.7 billion. So the core business is generating more cash. But like we discussed, that quarterly free cash flow plummeted 61% to $5.3 billion. And it's purely because of that massive CapEx surge. But here's the important context. If you look at free cash flow over the last 12 months, the TTM number actually increased 10% to $66.7 billion. That TTM figure gives you a much smoother, more reliable picture of their real cash generation power. It shows the underlying business is strong. And that other income swing, 2,000% looks crazy. It was basically a big gain on their investments in other company stocks compared to a loss last year. Great for the bottom line this quarter, but it's volatile, not core operations. You don't really count on that continuing.
Right, not something you build your strategy around. So with all these numbers crunched, what does this mean for Alphabet's valuation? The report doesn't give us a PE ratio, obviously, but how do these results help us think about whether the current stock price is justified? What makes it a premium growth company?
Well, the strong growth in both revenue and profit, and especially that big jump in Google Cloud's profitability, that definitely supports higher valuation multiples. Alphabet's generally seen by the market as a premium growth company, and results like these just reinforce why. You've got cloud margins improving, huge AI investments, good cost control underneath it all, diversifying revenues. It all adds up to reducing the perceived risk. Investors feel more confident. And since stock prices are really about betting on future earnings and cash flows, these results suggest stronger, more reliable cash flows ahead. That justifies paying a premium for the stock now.
Okay, let's switch gears slightly and look at the GOOG stock chart itself. From a purely technical angle, what's the picture? What trends, levels, or indicators would technicians be focused on right now?
Technically speaking, GOG has been in a pretty clear uptrend since late 2022 or early 2023. You see that classic pattern of higher highs and higher lows. Key levels to watch right now. Immediate resistance is probably around $207.27, a recent high point. On the support side, you've got levels around $182.74 and $174.08. And the really strong long-term support is likely down near the 200-day moving average, which is currently in the $140, $150 zone. Looking at the moving averages themselves, the shorter-term ones, like the 20-day EMA, are above the medium-term 50-day SMA, and both are well above the long-term 200-day SMA. That's often called a golden cross setup technically. It suggests the bullish momentum isn't just a short-term thing. It's pretty well established. These averages often act as support during pullbacks. You also see trading volume picking up during the significant price moves, which kind of confirms the strength behind them. So yeah, the technical picture seems to back up the fundamental story of strength and investor confidence.
So putting it all together, fundamental and technical, what's the outlook for the GOG stock? Short term, medium term, especially with this big AI push front and center.
Short term, well, you could see a bit of choppiness. That high capex hitting the quarterly free cash flow might cause some near-term jitters for some investors, but the underlying operational strength, plus the whole AI and cloud narrative, should provide pretty solid support, I think. And resolving legal issues could also help reduce uncertainty. Medium term, the outlook looks quite positive. Assuming they execute well, you'd expect continued growth and better profitability from cloud. Plus, seeing those AI investments actually start to generate revenue in search and YouTube, alongside the ongoing diversification, that should all contribute to sustained financial performance. That's where the AI strategy really needs to show its payoff.
Makes sense. But every investment has risks. Based on this report, what are the main risks and, conversely, the big opportunities facing Alphabet as they keep pushing hard on AI?
Okay, risks first. A big one is always the macroeconomy. If there's a global slowdown, ad spending could take a hit, and that's still Google Services' main moneymaker. Competition is fierce, especially in AI and cloud. Microsoft, Amazon, they're not standing still. That puts pressure on margins and market share. Then there's regulation, antitrust, data privacy. That's a constant background risk for Alphabet globally. And finally, there's the risk that those huge CapEx bets just don't deliver the returns they're hoping for. It's a lot of money to spend. On the opportunity side, though, integrating AI deeper into everything they do, search, YouTube, ads, cloud, that's a massive opportunity to improve products and find new ways to make money. Google Cloud still has huge potential to grab more market share and become an even bigger profit center. Continued growth in subscriptions and YouTube adds nice diversification. And, importantly, they have a fortress balance sheet. Lots of cash, giving them flexibility for more investments or acquisitions.
So, wrapping this up, what's the key takeaway for you, our listener?
I think the main message from Alphabet's Q2 results is you're seeing a company aggressively investing in its future, specifically AI and cloud. Yes, it's impacting free cash flow in the very short term, but it seems like a calculated gamble for long-term leadership. And crucially, the underlying core businesses are still very healthy and growing. They seem committed to making that AI-first vision a reality.
Which leaves us with a thought to ponder. As AI keeps disrupting everything, just how much will Alphabet's massive spending spree today shape the next decade of tech? And what clues will you be looking for in their next earnings report to see if that big bet is truly starting to pay off?